Oh, welcome into a daily editorial here on the KE Report. In this daily editorial, I am chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. And Jordan, we're not going to look so much at the individual charts of gold or GDX or GDXJ. What I first want to do is talk about the relationship between gold and gold stocks to the U.S. markets. I have a gold to the S&P chart right here, and after a nice bounce, unfortunately quite the flush out for last year from April through September, we got a very nice bounce into the tail end of December, but now we've been back in this general downtrend. This obviously has a lot to do with the U.S. equity markets continuing to get capital flowing in and now inching even closer to all-time highs. But the fact of the matter is, something that you and I have talked about is that we really need to see the metals start outperforming the U.S. equity markets. Can you address the relationship right now and still what it seems like the ability for U.S. markets to outperform the precious metals?
Yes, and one thing I'll note, Corey, because I don't think I mentioned this in the last couple of weeks, and I've been looking at the last two cycles and when the Fed does cut, it's really the cut that starts the period of outperformance from precious metals against the stock market. So the fact that they have not cut rates yet, I guess that given that history, we shouldn't be too disappointed in the bigger picture that precious metals have not outperformed yet. But here and now, it is very disappointing. I mean, if you look at gold against the S&P 500, it had this big move up at the end of the year. And since it peaked, I mean, it's basically just gone straight down. I mean, there's been, maybe a move up for like a day or two, but I'm looking at a chart of that with the 400-day moving average. And for example, you go back to 2017 and it had two rallies fail at the 400-day. And then at the end of last year, it had a strong enough move where it got well above the 400-day, but then it just lost it. And in the last month or so, it's tried to get back above it, but it's failed two or three times, and now it's trending down again, where it looks like that ratio, this is gold to the S&P 500, is going to go back down and retest I think the low it made in October or September. And GDX or gold stocks against the S&P. That's rolling over too. I mean, it's a little bit stronger because gold stocks have been stronger than gold recently, but both of these ratios, unfortunately, they made this strong move and they just weren't able to sustain it. They're just going right back down. And it's a similar thing happened in 2016 with respect to the ratio just shot up, but then while it consolidated for much of 2016, it never made a higher high. And so that's really what we need to see. And even though this ratio could not or it may not do much until the Fed cuts rates, I mean, that's important for a bull market in precious metals. I hear people arguing and saying we're in a bull market, but just looking at these charts, you're not in a bull market in precious metals. Number one, when they're not making any higher highs, and number two, when they're underperforming the stock market, as these ratios indicate. So not a good sign here in the near term, but in the bigger picture, it's not totally disqualifying because they're really not going to start to outperform until we see a rate cut or until the yield curve starts to steepen aggressively, because that usually happens because of a rate cut, or when there's not a rate cut, it happens because inflation expectations are taking off.
Yeah, very good comments. And right now, as much as people still want to think that a rate cut is coming, we're very much in flux with what the central bank, what the Fed is going to do. And you need to consider that U.S. markets staying strong gives them a little bit more cover to not cut rates. But it is kind of funny that we are already talking about cutting rates after it was really just in December when the Fed did that 180, or I at least called it a 90-degree turn to more of a pause rather than rate cutting. Let's also take a look at what's going on around the world. Earlier this week, we did have some better economic data out of China. It wasn't straight across the board fantastic, but it was encouraging to see some sort of a rebound. Now, the argument can be that the People's Bank of China has freed up so much capital and injected so much capital in that last quarter that's what helped it. But either way, it still shows that central banks do have the ability to at least save or somewhat support their economy. What do you think about that overall news, recent better economic data, and really what it means for the global economy if China is actually improving or at least stabilizing?
Yeah, I mean, whatever they're doing, it's working at least here in the short term for the markets. And I mean, looking at economics is important because we are in a late cycle in the U.S. and obviously different countries are at different points in their cycles. But it's important to know what's going on in the economies just so you have a broader view of what's going on. But with respect to markets, just because we're in a late economic cycle, Corey, that doesn't mean that these markets can't have a strong 6 or 9 months, or maybe even a strong 12 months. It's just something to keep in mind. And we've talked about the S&P 500. I mean, it's had very bullish action recently where it retested 2,800, which was resistance. So it's making higher highs. U.S. stocks are on their way to retesting and making a new all-time high. And not surprisingly, precious metals have been getting crushed in the last several trading days. Now, looking at emerging markets, for example, because you mentioned China, I'm looking at EEM, and I mean that's also made a higher high recently. I'm looking, and it hasn't quite made a new 52-week high, but I mean that right now is at about an 8 or 9 month high, and as I said, it's made a higher high, so that's encouraging. This uptick that we're seeing in Chinese economic data, again, who knows how sustainable it is, but even if it's only sustainable for a couple quarters, that is still going to be good and helpful for the global economy. And, in that scenario, Corey, where the global economy, maybe it doesn't get that much stronger, but it stabilizes for a couple quarters, maybe even 3 quarters, and it avoids going into a global recession. That's not that helpful for precious metals. Now, what it is helpful for, I'd say, is probably copper and the base metals. So that's something that people could focus on. I mean, I think you want to look at companies individually. You don't want to necessarily just go buy a random copper company because you think copper might outperform gold. I think you should evaluate everything individually on its own quality. But that being said, I mean, there is a chance that we could see copper faring better than gold here over the next couple quarters. And again, as I said, if this continues with the global economy and it stabilizes, it's not really the best case scenario for precious metals. So it's important to watch these markets and assess how sustainable recent performance is. And to me, it looks like it's probably going to be sustainable for at least much of the rest of this year.
And that's a key distinction, is that even though it might not lead to a full-fledged, say, bull market in some of these countries or the emerging markets, there is this stability that could definitely come back into the picture, especially when you consider just how bad stuff was going for these countries and economies recently. So maybe some sort of a stability move, and that could also be, again, on the back of what we're seeing with central bank policy, more of a pause. Let's also talk about the bond market, because we've seen some reversals in the bond market. We were sitting there with rate cut expectations that the market was pricing in by the end of the year. That's toned down a little bit recently, again, because I think maybe bonds got a little overdone on the buy side, pushing yields down so low. What do you think about what the bond market is telling us as well?
Yeah, Corey, this is going to be very interesting to watch over the rest of the year, just to see if the recent low that we made in yields, if that is going to be a low that holds up for the rest of the year, or not. Bonds got very overbought, yields got very oversold, so it's natural that we are seeing a move in the other direction. But is it a counter trend rally That probably depends on timing because I don't see yields going that much higher. But if we get a stronger global economy, let's say for 9 to 12 months, for example, in that scenario, it's hard to see yields going down that much. And it's not just yields in the U.S. Global yields have been really oversold, so those are also rallying. And these are based. I mean, these are leading indicators for the Fed. I mean, the 2-year yield got down to the low 220s. Now it's back up to 230 or so. I don't see how it's doing today on my screen. It hasn't updated yet. But as of last week, at one point, we basically had a rate cut priced in, by the end of January or by the end of the next March meeting, and we had a 30% chance of 2 cuts by January. But that is obviously going to change as we're seeing here. Yields are rallying, and if the global economy is at least stabilizing, and it's going to stabilize or strengthen just a tiny bit for most of the rest of this year, that is going to that's going to decrease the odds of a rate cut. So all this stuff it's in flux. I mean, it's constantly changing. It changes day to day, but it's just amazing, Corey, how last week you look at the Fed funds futures, they're basically pricing in a rate cut in the next 12 to 15 months. And I mean, who knows where that's going to go? Because again, if the global economy is stabilizing, these yields are probably going to rally for more than a month or two. And, that would, again, decrease the odds of a rate cut. So everything is a fluid situation here and now. And, I guess it's just a question of this fledgling economic or global stabilization that we could be seeing. How long could that last for? How sustainable is it? Because if it's sustainable and it lasts for more than a quarter or two, then that's probably going to push back rate cuts beyond early next year.
Now, touching back on what this all means for the metals, is it actually sounds like to me, and maybe you can correct me, but almost that we're going to be in this summer doldrum season, or again, a range-bound, sideways, possibly quite boring trade for the metals as everything kind of sorts itself out. If the economies do a bit better globally, and if central banks are not cutting rates because they are seeing just a general stabilization around the world, that could last for a couple, if not 3 quarters of relative boringness for the metals. Is that correct?
Yeah, that's very possible. And I mean, we can talk about the dollar next week, but there's kind of a paradox, because if you see the global economy strengthening, that's kind of better for or that's worse for the dollar. So, I mean, you could see dollar weakness in this scenario. Right now, sentiment on the dollar is really, really bullish. So you could get some dollar weakness out of that scenario, which could stabilize gold. But remember, we had huge dollar weakness in 17 at the end of 16, and that didn't, gold wasn't able to break out in that scenario. So it's really, you have to get some kind of, if it's not going to be a rate cut for gold, then you have to get some kind of a reflationary move. And I don't, we could get a temporary reflation here in base metals and global equities. But in that scenario, I mean, gold is not going to break out in that scenario. So, yeah, even though gold got close again, and, the miners, their breadth is really encouraging, but they didn't quite, get through what they needed to get through to achieve a bull market. So, it's kind of back to a range bound market, so to say. And again, the months ahead, it'll be very interesting to see how precious metals perform, given the potential for the global economy to stabilize, at least for this year.
All right, and that's a key distinction, at least for this year. The metals ended last year fairly strong, but that was after a big sell-off about halfway through the year. So now this year, as long as they can maybe stabilize some of these slightly higher trading ranges, it can be encouraging, but I know, still quite boring for all those metals bulls. Jordan, it's great having you on the show. Thanks for taking some time today, and everyone, go click that link below and visit Jordan's website, The Daily Gold. Thanks, Jordan.